Welcome back, fellas. In a recent video, we talked about a dividend ETF SCHD. And since many of you wanted to learn more about dividend income, today we are going to share another high-end paying ETF, the JP Morgan Equity Premium Income ETF, ticker symbol JEPI. If you're looking to generate stable income and grow your portfolio, you should seriously finish this video. So grab a seat, hit that subscribe and like button down below, and let's explore the incredible power of JEPI together. Dividend investors should be familiar with the concept of a dividend trap. This term refers to a situation where companies entice investors with extraordinarily high dividend yields, but in reality, those dividends are not sustainable in the long term. It's akin to a trap set for investors who are enticed by the allure of lucrative dividends without carefully considering the financial health of the company. Let's examine a classic example of a dividend trap using the 1-year price history chart of Big Lots, identified by the ticker symbol BIG. Notice the remarkably high dividend yield displayed on the chart, reaching close to 16%. At first glance, such a substantial yield may appear incredibly attractive. However, it begs the question, what good is earning a 16% yield if the underlying stock price has plummeted by more than 70% within a year? And here is another example. If investors only focus on the yield, the 26% yield is a screaming buy. But the reality is, the stock price dropped for more than $70 per share to around $10 per share in a year. Obviously, you don't want to invest in these dividend trap stocks. These scenarios highlight the importance of exercising caution and conducting thorough research when delving into dividend investing. Investors should not solely focus on the allure of high dividend yields, but also consider the overall financial stability and performance of the company. Blindly chasing elevated dividends without evaluating the underlying fundamentals can lead to significant losses and disappointment over the long term. One way investors can get some protection from dividend traps is to turn to ETFs, or exchange-traded funds, that focus on dividend yield. These ETFs are made up of a bunch of different companies, kind of like a one-stop shop for dividends. The JEPI, short for JP Morgan Equity Premium Income ETF, is one of those ETFs that have been delivering close to 12% annual dividend yield. And the best part is that it has an amazing track record and isn't a dividend trap like the others that I just showed you. Now, before we dive deeper into JEPI, let's quickly recap the criteria for a good dividend ETF. You want to look for low volatility, a high number of assets under management, low expense ratios, and a long track record. Well, the JEPI checks off most of those boxes and even has some unique features you won't find elsewhere. The expense ratio for this ETF is 0.35%, which isn't too shabby. It means that for every $1,000 you invest, you'd be looking at about $3.50 in annual fees. The dividend yield is 11.85%, which means some serious income potential. Inflows to this ETF have been huge in the recent months. The ETF now manages a massive $25 billion in assets. That's a whole lot of investor confidence right there. And most importantly, investors are still pouring capital into this ETF. If we look at how JEPI invests its capital, things get even more intriguing. This ETF employs not one, not two, but 3 investment strategies that make it stand out from the crowd. We've got the equity income strategy, which focuses on dividend-paying stocks. Then there's the capital appreciation strategy, aimed at long-term growth by investing in high-quality stocks with attractive valuations. Again, nothing too out of the ordinary. But here's where it gets interesting. JEPI also uses covered call option strategy to generate additional income. Okay, I know we probably owe you some explanation at this point. Covered call options are a unique twist. Basically, investors who own shares of a company, the underlying asset, can sell call options on those shares to generate additional income. When they sell those options, they receive a premium, which is just a fancy way of saying payment. It's like getting paid for letting others potentially buy your shares at a specific price in the future. This strategy is often used by investors who have a neutral to slightly bullish outlook on the asset. If the stock price remains below the strike price when the option expires, the person who sells the option, in this case you, basically pockets the payment while you still own the underlying stock. In other words, a covered call allows investors to earn income while still holding onto the shares. The drawback of covered call is that it can limit capital appreciation to some extent. You can see in the chart that as the underlying stock prices keep rising, the payoff is limited or capped at the strike price. All in all, a covered call allows investors to receive premiums upfront while still enjoying some limited upside price appreciation. And it's exactly the selling of call options that's responsible for JEPI's jaw-dropping high dividend yield. Now, if we look at JEPI's holdings, we see that this ETF has effectively diversified its allocation across various sectors, achieving a healthy and balanced portfolio. The top holdings consist of renowned, high-quality stocks within the S&P index. What is particularly impressive is JEPI's focus on selecting stocks that demonstrate low volatility. This level of precision in their selection process is truly remarkable, resulting in a portfolio of exceptional quality picks. As a result of its portfolio construction, JEPI has been very resilient in recent market downturns. Remember what we said earlier. What's the point of investing in an ETF that gives you a high dividend yield if the price swings like crazy, right? So let's take a look at the graph comparing JEPI and S&P 500. Since its inception in May of 2020, JEPI has nearly matched the performance of the S&P 500, returning a total of 44% versus a 47% gain for the SPY. That may not sound impressive on the surface, but keep in mind that JEPI generated that return with about 30% less risk. Let's look at the swing in the return SPY experienced in 2022. The trend for JEPI is more stable. The current volatility for JEPI is at 1.88%, while SPY has a volatility of 3.28%. This indicates that JEPI experiences smaller price fluctuations and is considered less risky than SPY. And because JEPI is less risky, it has a higher maximum drawdown and a higher Sharpe ratio compared to SPY. As a result, the JEPI is an investment option with better return given the same amount of risk. It performs better than the SPY when the market falls and has total return just slightly lower than SPY. The only downside JEPI has is it was recently formed in 2020 and doesn't have a long track record to evaluate its performance. And that, my friends, introduces a certain level of risk for investors. After all, past performance isn't a crystal ball for future performance. That aside, I feel JEPI offers a hedge fund-like strategy in an ETF structure, and investors should consider whether JEPI is suitable for their objectives. It is quite reasonably priced for what it offers anyway. And there you have it, folks. We've explored the world of dividend investing, focusing on the JEPI ETF and its remarkable 11.86% dividend yield. Remember, not all high-yield dividend investments are traps, and JEPI is a shining example of that. It's crucial to find the right balance between yield and sustainability, and the JEPI seems to have hit the sweet spot for that. If you found this video helpful and informative, don't forget to give it a thumbs up and subscribe to our channel for more exciting investment insights. As always, stay tuned for our next video, where we'll continue to unravel the mysteries of the financial world. Happy investing and more to follow.